สวัสดีค่ะทุกท่านขอต้อนรับทุกท่านเข้าสู่กิจกรรมงานเสวนาของเราในวันนี้นะคะเดี๋ยวอีกสักครู่หนึ่งค่ะดิฉันจะขออนุญาตเริ่มงานสัมมนาในวันนี้เลยนะคะขอต้อนรับทุกท่านอีกครั้งนะคะหลักสูตรอบรมของเราในวันนี้นะคะจัดขึ้นในหัวข้อจัดโครงสร้างอย่างไรให้โดนใจนักลงทุนซึ่งกิจกรรมในครั้งนี้นะคะจัดขึ้นโดยความร่วมมือระหว่าง Expara ประเทศไทยและตลาดหลักทรัพย์แห่งประเทศไทยโดยห้องเรียนผู้ประกอบการค่ะสำหรับการอบรมในครั้งนี้นะคะถือเป็นส่วนหนึ่งของโครงการ The Rapid Response and Recovery Program โดย Youth Business International ที่ได้รับการสนับสนุนโดย google.org ดิฉันธนันพร เสจินดาหรือว่าแนนนะคะผู้เขียนหนังสือ Startup Fundraising ขออนุญาตรับหน้าที่เป็นผู้ดำเนินรายการในวันนี้ค่ะเอาละค่ะแล้วก็สำหรับการบรรยายในวันนี้นะคะอันนี้ค่ะก็โครงการ Rapid Response and Recovery Program นะคะของ Google ของ Youth Business International ที่ได้รับการสนับสนุนของ google.org นะคะก็จะดำเนินการระหว่างช่วงเวลานี้เลยนะคะถึงเมษายนปีหน้าค่ะสำหรับการบรรยายในวันนี้นะคะดิฉันขออนุญาตพาทุกท่านดู agenda สำหรับการบรรยายในวันนี้ค่ะเราจะใช้เวลาฟังคุณดักลาสบรรยายในหัวข้อ Build a Fundable Company begins with the right structure นะคะประมาณเกือบ1ชั่วโมงโดยที่รวมกรณีศึกษานะคะจากนั้นก็จะไปถึงสู่ช่วง Q&A จากนั้นนะคะดิฉันจะกลับมาพบกับทุกท่านอีกครั้งในช่วงท้ายเอาละค่ะและเพื่อไม่ให้เป็นการเสียเวลานะคะดิฉันขออนุญาตเริ่มการเสวนาในวันนี้เลย Ladies and gentlemen, thank you very much for joining us on Building a Fundable Company begins with the right structure by Douglas Abrams, CEO and founder of Expara. This webinar is a special collaboration between Expara Thailand and the Stock Exchange of Thailand by SET Enterprise. The initiative forms a part of Youth Business International, the Rapid Response and Recovery Program, supported by google.org. Without further ado, ladies and gentlemen, may I now present you Douglas Abrams. Douglas, it's your turn now.
Okay, thank you. Thanks, Nan, for the introduction and starting my video. Tonight's topic, it's called Building a Fundable Company Begins with the Right Structure. Appreciate everybody taking time out of your busy evening to join this program. This topic is one that's very close to my heart because in Expara, we're doing venture capital funds. We have a venture capital fund that invests in Thai startup companies. It's a fund that is invested by Government Savings Bank of Thailand and our co-host today, the Stock Exchange of Thailand. So we've been investing in Thai-based startup companies in that fund since 2017, and I've been in Thailand since 2007, working with and investing in startups. I think a lot of you know that many startups fail, and there's some difference of opinion about the numbers, how many startups fail, and when do they fail. I have done some of my own research on this topic, and usually I'll estimate that about 75% of startups which receive at least one round of venture capital investment will fail if we define failure as not either returning zero on the original investment, meaning the entire investment is lost, about 50%, and another 25% returning less than one time. So that's a pretty significant failure rate. But this failure rate, it's not a bad thing. The failure rate of startups, high failure rate of startups, is the reason that successful startups generate such high returns. The high returns generated by successful startups are what bring investors to startups. So it's not a bad thing that a significant percentage of venture-funded startups fail. However, what I want to talk about tonight is a different type of failure, which I believe is bad. And because why? Most venture funded startups which fail for what I would call unavoidable reasons. They fail because there wasn't enough demand for their product. They fail because there was demand for the product, but the competition was better at the startup in supplying that demand. They fail because, for example, terrible exogenous conditions like we had in 2020 around the world and in Thailand for a lot of the year. They failed because problems in the team, they didn't have the right strategy, et cetera, et cetera. So these are all reasons to fail that are, I believe, baked into the process and already factored into pricing and help to generate high returns for companies that succeed. But what I want to talk about tonight is startups that fail before they even really get started. And we meet what I would say are way too many of these startups in our investment activities in Thailand. So what do I mean by that? I mean, we meet startups who come in to pitch us and for investment. And this startup, for example, in a typical case, the product looks interesting, the market opportunity seems good, they have some innovation, they're solving a painful customer problem, we like the team, they look like they have a good strategy, and maybe they even have some initial traction. But once I start asking questions about the company's cap table, and I'll talk about that a little bit more in a minute, what does that mean? Then I realize that the company is either uninvestable or there's already significant problems with the investment. And those significant problems come from mistakes that the entrepreneur made or the founding team made during what I would call the structuring phase of the company, meaning they introduced some significant problem into their cap table, which it's either going to be very difficult to fix, expensive, time consuming, or maybe even not possible to fix. So I would, I feel like that is a reason that no startup should fail. No startup should fail because they made a mistake in their cap table, because that is not, I don't believe, part of the game. Well, the game is you create a great product, you create an innovative product solving a painful problem for customers, you get out there and you do the best you can to own the market, and either you win or lose, and a lot of times you're going to lose, and hopefully at least at some point you win. But you shouldn't be disqualified from the game because you made a cap table mistake. And that's what I'm going to talk about tonight, because hopefully we can help entrepreneurs who are just getting started or haven't already structured their cap table or are in the process of doing that and can avoid making these mistakes. I think if you as an entrepreneur can avoid this type of mistake, you're already one step ahead. So so this is some background on me, which I think we don't have to spend a lot of time on, but I'm originally from the US, and I went to UPenn and Wharton. I worked on Wall Street at JP Morgan for 14 years. I came to Southeast Asia in Singapore in 2000 and have been doing venture capital investment and teaching at National University of Singapore, SASIN in Bangkok, and in other universities around the region, teaching entrepreneurship and venture capital, and combining that with venture capital investment, incubation, acceleration, and also training workshop for entrepreneurs and investors. This is a little bit of background on Expara. So we're regional, early stage venture capital and accelerator. now talk what I'm going to talk about today. So cap table and 3 what I call red flags, which are red flag means when investors are listening to your pitch or listening to an entrepreneur's pitch or looking at their slide deck or evaluating their business plan. A red flag is a danger or warning sign. So something that jumps out at the investor and makes them pause in considering this investment. So 1 red flag may be okay, 2 or 3 red flags, it may not even be worth pursuing this deal at that point. So I'm going to try to help identify those and help you avoid those if you're an entrepreneur. Now, I have experienced this so many times that I have a series of questions that I ask in every first pitch meeting designed to identify whether the company has is currently or is about to, suffer from any of these flaws in their cap table or what I call messy cap table conditions that create these red flags. And it's actually I had several calls today where I was going over these questions with companies, and unfortunately I can tell you I had, I think, 3 calls with companies today. Out of the 3 companies I talked to, 3 triggered 1 or more red flags in their cap table. So this is not a rare occurrence, and it's not something that's just from entrepreneurship or venture capital theory, but it's some real, a real unfortunate situation in our market right now. Good news is I'm also going to talk about how to fix it. So yeah, don't worry, not just about the problems, but we'll talk about what we can do once we have these problems. So for audience, so we interested to hear from the audience. We have a poll that you can answer because we want to know, are you, it'd be helpful for us to know if you're an entrepreneur considering raising money, an entrepreneur with a cap table issue, an investor considering investment in a startup, or just general interest, so meaning don't fit into any of the above categories. And I think can everybody see the progress live or only me? So I can see the poll results live.
Yeah,
So
only you, Douglas.
Only me, okay. Oh, so some other people can see, okay. Then looks like we're about a little less than half of us are entrepreneurs considering fundraising. And then another 1/4 are considering a possible investment in a startup, and other remaining 40% about are general interest. So I think fit into none of the above categories. So far, nobody says they're an entrepreneur facing cap table issues, which is great. So that hopefully everybody already has a clean cap table, or will be able to, if they're still structuring their cap table, will be able to avoid these problems. Okay, so I'll share the results. Here you can see. Okay, so a couple of questions that I like to ask when discussing investment startup. So oftentimes we get startups that have traction. So they have some revenue, they have people in the company. This suggests there's some money in the company. So first thing I want to know is, so how has the company been funded so far? Is it funded only with founders' money? Is it funded with some combination of founders' money and external funding, either debt or equity? And if there's more than one founder shareholder, how is the equity distributed among those shareholders? And if there are any external shareholders, so if anyone already put money in the company in exchange for equity, how much do each of the shareholders own? And so these are a couple of common questions. Then what are like some of the immediate problems that come up? Like, what are some of the answers to these questions that trigger my search for more information because it already signals or indicates the existence of a red flag? So one of the somewhat common situation, I got a loan from my sister or brother or aunt or mother, so some sort of family, friends and family investment, and we don't need to, the entrepreneur will continue with, we don't need to worry about that loan because we don't have to pay back because it's from family. This is definitely a huge red flag. I'm going to talk about this a little more later, but this would fall into the category of undocumented or poorly documented loan or investment into the company. And if there's any sort of money in the company, every dollar that's in the company needs to have been accounted for, and it needs to be reflected in the cap table. So if anybody either put in money or loan money to the company, no matter what their relationship is to the founding team, this needs to be very clear because, when I, example, I was having this exact conversation with an entrepreneur a while back, said, so we don't need, and he said, yeah, I got a loan from my sister, and it was not an insubstantial amount. I mean, it was, 5 or 10 million baht. It's real money. Even if you're rich, I mean, that's still real money. And so he said, oh, okay. But he said, we don't need to worry about that because we don't have to pay it back. And I'm like, well, what do you mean? What was the conversation you had with your sister when she gave you that loan? Oh, she just said, don't worry about paying this back until the company is successful. And I said, oh, wait a minute. So actually, we sort of do have to worry about that because she's expecting to get paid back when the company is successful. Oh, well, yeah, I guess that's true, yeah. And I said, but what does that mean? When is the company successful? How do we determine if the company is successful? Does that mean it raised the next round of funding, or that there was the company was sold, or the company made, so, well, we didn't really talk about that. And then that type of missing conversation can lead to a lot of misunderstandings later. And the fact that it's a family member or a friend, it may not make it better. It may make it much worse. Because why? Because imagine that this conversation doesn't get had until the company is worth, for example, $100 million. And now the family member who basically funded the company with a loan is expecting to get more than paid back the amount of the loan. This was never clarified, and now this can create not only legal problems for the company, but also family problems. And I asked this entrepreneur, so of course nobody in families ever argues about money, right? I mean, obviously they do in certain cases. So another common problem answer. Okay, we had one of our early angel investors put in 1 million Thai baht and owns 20%, and now the company is trying to raise, they're trying to raise 10 million Thai baht for 10%. But now they have a huge problem because why? The angel investor got put in 1 million for 20%. Now they want to go out in the market to raise 10 million, for 10%, which means the value of the company has increased exponentially. When did this angel investor put that money in? Okay, last year. So how can the value of the company have changed so much since last year? Now we have a big problem in negotiating and agreeing on the current valuation of the company with new investors. And we have a problem because this very small investor has a huge equity stake. And then another common problem, one of my co-founders who left the company is holding 20%. And we call that dead equity. I'll talk about that in more detail on upcoming slide, but this is another huge hole in the cap table problem that we definitely do not want to see. So I mentioned cap table many times already, and it's in the title of our talk, subtitle of our talk. So what does cap table mean? It sounds complicated, but actually, cap table is short for capitalization table, and the cap table explains where did the company get its capital, and how is that capital accounted for. So basically, it tells the distribution of the ownership in the company, and if you're raising money, it'll show both before and after investment. So it'll show how much money did the company raise so far, and who did it raise it from, and on what basis, and who owns the equity in the company based on previous investment, and also what the new cap table will look like post-investment based on what's being discussed in our current negotiation for the investment in the company. It'll also show not just, cap tables typically show not just the actual shares in the company, because some investors in the company may have received options or equity convertible instruments like convertible notes or safe notes. So cap table will show what we call the ownership of the company on a fully diluted as converted basis, which means any investment that came into the company in the form of a convertible instrument will be shown in the cap table as if it was fully converted. So this means every investor will be shown with the least amount of equity they could possibly have, assuming any convertible instruments were in fact converted into equity. Now, why is cap table so important? When companies raise money, and especially high growth startup companies raise money almost exclusively by selling equity. We know that public companies raise money through both equity and debt, but high growth startups typically fund only with equity. We'll talk about why equity versus debt in another lesson, not tonight's talk, but startups fund their growth by selling equity, and this means that equity is the currency that startups have to bring investors into the company. And in order to grow successfully, startups need to attract and retain the best people. But startups typically have very little revenue and in most cases no profit. So how are startups going to attract and retain the best people without paying top salary? Because startups cannot pay top salaries, especially in the early stage, because they don't have enough money. And this creates potential deadly spiral for startups. The way they break out of that circle is they motivate both founders and key hires with equity. So the founders of the startup are motivated to make the startup successful because that will cause their equity to be worth a lot of money, and when they sell it, they can get a windfall. And the same thing for key employees. So basically, equity is the currency of growth of the startup, and the cap table shows how that currency has been used so far and how much of that currency is still available to be used on effectively funding future growth. So what does a clean cap table look like? Assuming that the company has not raised any, what I would call institutional or venture capital funding rounds, let's say if the startup has some external investment from what we call angel investors, then we would expect to see that the startup has founders and key management team owns 90 to 100% of the company. 100% if there was no investment, 90% if there was angel investment prior to this. So that means that we would like to see 10% or less owned by previous round angel investors, even if there was more than one round. And that includes any sort of lenders on convertible notes who would be converted into equity. We also it's okay to see 10 to 20% in an ESOP already. That would be factored into the founder and key management team share. So that, it could be management has 90% and the ESOP has 10%. This is probably still okay. but we don't want to see that management plus ESOP is anywhere below 80%. Now, like a lot of numbers in our business, this is not a, it's not a law or hard and fast rule, and there's some flexibility around that. So we might look at specific situation where management team plus ESOP was 70%, 75%, and it's still okay. But if it gets much below that, we're going to have a problem. So this is an example of a healthy cap table. So you can see here, prior to investment, so prior to the VC funding round, 95% of the equity, 95+% of the equity is held by the 2 key management team members and their ESOP. So 4.5% is held, 4.25% is held by an angel investor who put in $50,000 in the angel round. And everything else held by management team or ESOP. And you can see that post investment, this leaves the new investor comes in for 15% and leaving 85% for key management team and ESOP. So this is what a healthy, clean cap table looks like, both before and after, in this case, a seed round investment that followed 1 round of angel investment. So what are some of the dirtying factors? So when I say clean cap table, and now we're going to look at messy cap table. So what are some of the factors that cause a cap table to become messy? And 3 of the factors I'm going to look at tonight, and talk a little bit more about tonight, are what we call dead equity, dumb money, and excessive dilution. So we'll start with dead equity. Now, what does dead equity mean? Dead equity means equity that is held by anyone except full-time founders, financial investors who paid some market price for their shares, or an ESOP, and that's it. Any other equity. So any equity that is held by anyone other than full-time founders who are still with the company, financial investors who put in real money, not services, but real cash, and received equity at a then market price, and ESOP. Those are the only live equity in the company. So what does that mean? That's live equity because it contributes to the future success of the company. Now, you have to think about it this way. The startup company, and especially at the very early stage, they have a long way to go for success. Who's going to take that company to success is the management team, key employees, and future existing and future financial investors. So anybody other than that that's holding equity, we call that equity dead because it's not contributing to motivating the ultimate success of the company. The first case, part-time founders. So in venture capital world, part-time founder is an oxymoron. I don't know if you heard this word before, but oxymoron means a phrase that doesn't make sense because the first word and the second word are opposites. So, for example, you hear the expression jumbo shrimp. Shrimp means small, jumbo means big, so you can say that's an oxymoron. But in venture capital terms, part-time founders is an oxymoron. Why? Because by definition, a founder is full-time. There's no such thing as a part-time founder. So you can't be both part-time and a founder at the same time. You can either be part-time or a founder. And this is a very common situation, maybe one of the most common that I've seen in Thailand for immediate cap table problems. So why can you not be a part-time founder? The reason is you go back to if you go back to the statistic I mentioned earlier about our overall 75% startup failure rates, those were all startups with full-time founders. So if 75% of startups with full-time founders fail, what percent with part-time founders are going to fail is all. And even if it's not all, it's 99.99%, which is indistinguishable from all. That's problem one. And you can understand why that works when you think about how much time do you need to spend on your startup to be successful. You need to spend 7 by 24 by 365, so 7 days a week, 24 hours a day, 365 days a year, and 366 days in leap years for the next 10 years. And if you don't do that, your startup's going to fail. So how are you going to do that when you're doing something else because you're part-time? And I hear a lot of, when I bring this up with a lot of founders, they get a little defensive and say, but I'm spending 90% or 99% of my time on this business. But 99%, it's not 100%. You're still not full-time. And one very common structure here is, especially again in Thailand, the founder owns 2 companies. One company is an example software development company that he's been running for several years, generates nice cash flow. And then he set up a second company, which is the product company, which is a startup, and he's raising money for that second company. And his view is, running both companies is good because the development company, software development company, is going to generate steady income for him, so he doesn't have to worry so much about income from the startup. And that sounds plausible, but it's totally wrong. Investors never want to be in that situation. Why? If the founder is running 2 companies and I'm only invested in one of those companies, so I'm invested in his startup, but not in his development company. So now he can win 2 ways. He can win if his startup succeeds, or he can win if his development company succeeds. I can only win one way, which is when the startup succeeds. So our interests are not aligned, and he will have, under the worst possible circumstance, our interests will become totally misaligned. How does that work? Let's say the development company is doing great and the startup company is struggling. So what should he do? Now he should spend much more time with the development company because it's doing great. So he's going to walk out of our startup at the worst possible time for a startup. So anyway, you can't be both part-time and a founder. Founders have significant equity stakes. So a typical founder equity stake should be, as I mentioned in the previous slide, let's say there are 2 founders. If they hold 90%, then probably like the CEO has 50 or 60% and the CTO has 30 or 20, 30%. Then if you want to be a founder, you can have an equity stake like that. If you want to be part-time, then you have an equity stake like everybody else. What does everybody else mean? Then if you're not a full-time founder or active investor, your equity stake should be less than 1 or 2%. So if you want to stay as a part-time founder, it's okay, but then you have to give up the vast majority of your equity stake to a real full-time founder who's going to take over the company. You can keep a very small stake as an advisor. If you're willing to come full-time, then great, you can get a founder-size equity stake. Another very bad answer I hear in this case, or a bad argument that the founder will make, they'll say, oh yeah, I will come, I'm going to start full-time as soon as we close the investment, as soon as the investment comes in. This also, face value sounds plausible, but it's totally wrong. Because why? What is the message that we're getting? The message is, I'm only going to come full-time once investment is secured. But the investment pitch is, this is $1 billion company, $1 billion opportunity. If it's really $1 billion opportunity, why are you so nervous to join full-time until there's money in it? It totally undercuts the entrepreneur's pitch that this is a great opportunity, and it makes it seem not sincere. So starting full-time after the money comes in is even worse than saying that you're not full-time in some respects. Okay, so next dead equity issue we encounter, inactive founders. So a founder who was with the company but left with a big equity stake. This equity is really dead because now the founder is gone. They're no longer part of the company. They're not contributing to the company's success. This shouldn't happen because you should never give equity up front to any founder. You should be vesting all your equity. And if they leave before the vesting period, they should have had that equity clawed back. But this didn't happen in many cases. And we have ex-founders sitting on huge equity stakes. And this one is one of the most difficult ones to fix, and also one of the typically most fatal cap table problems, because if we don't fix this, probably not, new investors are not going to be interested. Sometimes founders will suggest, okay, we'll buy them out, but who's going to buy them out? We're not going to buy them out as an investor because we don't want to buy shares from existing shareholders. We want to buy new shares, which then result in money going into the company to fund growth. Look at the third case, debt equity. I call this superstar strategic advisor. This also very common in Thailand, where the startup has recruited a critical advisor, which I agree, there can be critical advisors. But then they've given the superstar advisor a founder size stake. So the advisor has 10%, 20%, double-digit equity. Remember, they're not full-time founder. They're not a financial investor who put in cash. Therefore, they should have very small equity stake, if anything. So maybe 0.5% or 1%. When you see a strategic advisor with any sort of double-digit equity, this is a huge cap table problem. And again, going to be difficult to fix. Founders will say, but they were so important in setting up the company. I believe it. I believe they were important in setting up the company. But equity is not a reward for being valuable in the beginning. Equity is not a reward for not fundamentally a reward for what's already been done. Equity is a reward for what you're going to be doing in the future. And unless this advisor is going to become a full-time management team member, then they're in the same debt equity boat. Venture builder. So venture builders are companies that typically provide much more than funding for startup entrepreneurs, or sometimes even come up with their own ideas and hire entrepreneurs to grow companies. This means that oftentimes this means when a venture built startup meets a venture capital investor, equity is held, significant double-digit stake is held by the venture builder, which again, they don't fit into our definition of full-time founder or financial investor who bought their shares at market price, and therefore they're considered debt equity, and they're going to cause cap table problems. And the last one, again, a very common situation, technology vendor. So the company didn't have an in-house CTO and technical team. They needed to develop the first version of the product. It was very expensive. They didn't have the cash, and they thought it would be a great idea to pay the technology vendor in equity. This was not a great idea. This was a terrible idea. Don't buy anything with equity except investment. Because why? Because now the technology vendor, again, debt equity, they're not going to contribute they're probably not going to do version 2 of the software. And even if they could, by the time the company is raising the next round of funding and getting to version 2, we want the technology to come in-house. So the technology should be developed by the in-house technical team, not by a technology vendor. This becomes yet another form of debt equity. And again, I've experienced this situation many times in Thai startups. There are all sorts of reasons why it made sense. It wasn't necessarily, irrational decision, but it was not a good strategic decision for the company. And now we're going to have to figure out how to correct that. So what are some examples of dumb money that especially lead to excessive dilution? Now, I want to clarify about this term, because it sounds very pejorative. When we say dumb money, it sounds like the investor is being described as dumb. It's not true. It's not correct. When we say there's smart money and dumb money in venture investing, we don't mean the individual involved is smart or dumb. Just because somebody is a VC doesn't mean they're smart. Just because somebody is an angel investor doesn't mean they're dumb. And there are definitely smart money angel investors too. But what the distinction that we're trying to draw with smart money and dumb money. Smart money are professional venture investors whose full-time job it is to invest in startup companies, and dumb money are everybody else. And again, they may be brilliant, individually brilliant people, and they may even be really smart investors in some other asset class. Like they might be a real estate entrepreneur who makes great real estate investments. They might be the CEO of a very large and successful SME. They're really a brilliant entrepreneur, and they make great investments in their business, but they're not venture capital investors. So I put angel investors in quotes because a lot of the dumb money investors we see in Thai startups are self-declared angel investors. So one challenge I think with angel investors, I always like to say, who can be an angel investor? We have, let's say, 60 plus participants on our call. How many of our participants could be angel investors? All. Anybody can be an angel investor. Because there's no qualification process for angel investors. There's no explicit qualification process, and there's no implicit. What do I mean? They don't need a license to be an angel investor, and they don't need investors. So when you raise money as a startup from a venture capital investor, a venture capital fund, or a corporate venture capital fund, you know that investor that venture capital investor or CVC was given money to manage by investors in their fund or in their CVC. So those investors are not just self-declared. Angel investors are investing their own money. So they're not validated by any third party. That doesn't mean they're not good. Some angel investors can be great and some can be terrible. So you have to be careful about the quality of angel investors. But most of the really bad deals that I see showing up in startup cap tables before the seed round come from people claiming to be angel investors. The other source of dumb money is friends and family, and not because friends and family have bad intention, but because they don't understand how to make venture capital investments. Why should they? How to make venture capital investments is not easy. In fact, it's very difficult. And unless your friend and family happen to be professional venture capital investors or super experienced angels, they're not going to know how to do it. So what are some of the problems that crop up in these situations? I already mentioned in the lead-in some undocumented or unclearly documented investment or loans. So this is a huge problem, and it needs to be cleaned up before we move to the next stage. Now, the other consequence often of dumb money investment, the valuation was way too low. I gave that example in the previous slide. Angel investor put in 1 million baht and got 10%. And this means the founders were already excessively diluted in that round because the investor shouldn't have got 10% for 1 million baht. So they're already diluted, and now they're going to get more diluted because this is going to depress the next round valuation. So because they got too low valuation in the last round, now it's going to be harder for them, harder for the startup to get a market valuation in this round, because no matter what valuation methods we use, investors in the next round are going to tend to anchor on that previous round valuation, and it's especially if it was within the last 12 months. The other consequence of dumb money investment that leads to excessive dilution, which may be a little less obvious, is too high of a valuation. So you have the opposite case. The dumb money investor in the last round put in, let's say, 10 million baht for 1%. So they put in 10 million baht and got 1% of the company, which means the current valuation is extremely high, way too high. So why is that a problem? Actually, this led to the opposite of excessive dilution, correct? The founders were barely diluted, only diluted by 1%. The problem is next round, because if the last round valuation was way too high, this means that the next round has to be a massive down round, meaning if the company is very likely to be a massive down round, meaning the next round, when the company wants to bring in a professional VC, they're going to look at last round valuation and say, wow, that was like 10 times what it should be, which means we're going to have to cut. We're going to have to now invest in the next round at 10% of the last round valuation. And that's going to result now in massive dilution because the startup the founders are going to be, assuming the previous round investor was dumb enough to give a sky-high valuation, but not so dumb that they didn't include anti-dilution, then the founder is going to be excessively diluted in the next round. And then this is going to cause further problems because in the round after that, they're going to have to explain why they did a down round in the second round. Okay, so I have now introduced the key concepts in messy cap tables. And I think everybody should have a general idea of what are some of the things that we're looking out for. So remember, we talked about some of the problems that we look for, red flags, things like part-time founders, things like undocumented or poorly documented early round investments, things like non-standard deal terms, especially including deal terms that relate to valuation, equity, significant equity stakes that are held by anyone except full-time founders, financial investors who paid market price, and ESOP. So we're going to now present a real case. This is a real discussion that I had this week. So this is like fresh from the market. Again, it's not from a textbook. This was a real startup that I had a real call with earlier this week. It's a medtech startup based in Thailand, medical technology. They're looking to raise $15 million seed round. I really like the idea. I mean, I like the product. I thought it was innovative. I thought they're solving a painful problem for customers. I think they're in a fast-growing market that's going to reach significant size. I like the team overall. I thought it was a very interesting deal. But of course, I launched into all my questions, and here were this was some of the information that I got. So the CEO, the head of marketing, the CTO, and the development team are working full-time for the company, our CTO are working full-time, but the marketing guy is working full-time, but the development team is outsourced. The working full-time for the company, meaning they're working an outsourcer to develop software, but they're not employed by the company. They're working in a development outsourcer. The founder and CEO is currently working in Canada. He's using his salary to fund the startup. He will return to Thailand and join full-time as soon as the investment comes in. Progress for the company. So the first version of the app was developed by a different outsourcer than the one they're working with now. This one was paid half in cash, half in a promise of equity. The same current outsourcer has the same deal. This is because the company is trying to conserve cash. And the financing to date has been provided by the CEO, CTO, and friends and family. The CEO currently holds all the equity, but he has had promised in discussion with the CTO and his friends and family that equity will be issued to those others at a 66% discount to next round funding valuation. Okay, so that's those are the facts of the case. So what we would like to give everybody a couple minutes now to read through the case and then think about what cap table red flags do you see in this company from this case? And I can tell you there are quite a few. So the answer is not none. There are definitely some. So we're going to give you now a few minutes to work on that. So everybody, please read the case. You can discuss among yourselves if you want in the chat. And then let's see if we can identify as many cap table flags as possible, red flags as possible in this case.
All right, I'm counting down 1 minute. For the participant, if you have any comments or ideas, you have already identified a red flag, please use the chat. Douglas, is it 15 million Thai baht or US dollars?
15 million Thai baht.
Thank you.
Oh, so somebody asked about recording, but we're definitely recording everything so people can watch again. Yeah, so there was a question, there's a little confusing wording about the CEO. So the CEO is working he has a job in Canada. He's not working full-time. The marketing director is working full-time in Thailand. The CTO and development team are working full-time, but they're working full-time for the company, but they're based in an outsourcer. So they're dedicated to this project, but they're not employed by the company. So I see a couple of comments in the chat where which already definitely have identified some of the key cap table problems.
Okay, and the time is up. Douglas, would you like to show the answer now or?
Yeah, I think we can go to the answer because I think most of the answers are already in the chat, that we have very, very good answers from the participant.
All right.
So here, these are some of the ones that I know, that jumped out at me and that I think everybody, that some of our participants already noticed. So we have the part-time founder. He's not in Thailand and he's going to join full-time after the investment. As I mentioned, this is the worst. This is like the worst thing to say. I'm going to join full-time after the investment. Because why? Again, confidence. It's totally undercutting our confidence in the CEO's story. I mean, the CEO for this business, they're pitching it as a business that's going to be, $100 million, $200 million company. And in the meantime, he's in Canada working in another job. So now from his perspective, though, it makes perfect sense because, and what he told me was he uses his salary from this job to fund the company pre-investment. And that makes a lot of sense. So I understand that. The problem is that only works before you want investment from others. So you can do that in the early days, but as soon as you need money from investors, you need to now, cut bait, fish or cut bait. And we see two forms of debt equity, the first and second outsourcer. So it's even worse in this case because the first outsourcer was paid half in cash, half in equity, and their product can't even be used because the company had basically the work that they did was no good and it couldn't be incorporated into the company's product. So they're receiving equity, they got paid cash and they're receiving equity and their software is not even being used in the company. I mean, the equity doesn't get any more dead than that. And the second outsourcer, although they're currently using their product to launch the MVP, but they're also getting paid in equity. And you can almost be sure that the next version of software they're going to be not involved anymore, so they're going to be dead equity. Now, the other issue here, I didn't put in the case because it's too complicated, but the founder said they have an agreement with the outsourcing company that he can hire the development team and the CTO full-time after the funding comes in, and then they'll solve this problem. And that sounds great, but again, I've seen this situation with real startups in Thailand, and what happens is by the time the startup wants to hire this team, suddenly the outsourcer has a much better project and they put the team on that project. And again, this so-called option to hire the team, is it in the contract? No, it's another verbal agreement. So this is going to be unenforceable later, or very difficult to enforce later, and very difficult or impossible to get that equity back. And again, last one, we have poorly documented friends and family and inside funding. So we have money that was put in, as an investor, we don't like to see that, for example, management team or founders have convertible notes. They shouldn't be lending money to the company. If they want to put money in the company, they should be putting in additional equity capital. But in this case, we have friends and family and some members of the founding team with a poorly documented convertible note, and actually, I'm not even sure there is an agreement. It was a verbal agreement on this convertible note, and offering a discount of 66% off the next round. So somebody even asked this question, so if 66% is too high, what would be suitable? Usually, discount for a convertible note, it's something like in the range of 10 to 20%. Very rare to see anything more than 20%, and something like 66%, it's inconceivably high. So that's going to cause a huge problem, because the next round investor is not going to want to see previous round investors converting their equity at 1/3 of the valuation that investor is coming in at, because they're going to feel like this is not fair to them. And even though those investors came in early, but still the adjustment for that at 66% is astronomical. And the fact that management team is, the fact that the management team is doing that at the same time, I think the investor won't even, I don't believe investors going to even agree to that. I think what they would probably do is say, what we usually do if management is holding convertible notes, say, you're going to have to write that off, or we'll give you, some other type of compensation, but basically you're going to have to write off that investment. Okay, so good answers to the case study question. I think we have, I want to talk for a few minutes about cleaning up. So it is not impossible to clean up messy cap tables, but the way you typically have to clean up the messy cap table, it's extremely painful. And this is why I always like to tell entrepreneurs, it's much, much better to not let your cap table get messy, because cleaning it up is extremely painful. Because why? How are we going to clean up? The problem is equity is improperly or suboptimally distributed in this company. So that means we need to go from our current cap table, where anyone who shouldn't have a large equity stake no longer has it, and equity is back with management and the incoming investor. So usually the way that this gets cleaned up is we say, okay, new investors coming in, and they're only going to invest if the cap table is cleaned up. And that means everybody who's currently in the cap table with unacceptably large equity stake is going to have to give up most of their equity in this funding round. So for example, let's say we have management team with 60% debt equity, with 60% equity, management team plus ESOP with 60%. New investor is supposed to get 20%, and existing shareholders who are not supposed to have large equity stakes have their remaining 20%. So what's going to happen is we're only going to put in the investment if something like 18% of that 20% gets transferred back to management or transferred into the ESOP. leaving the previous round shareholders, instead of 20%, now they have 2%. So that means they each accepted a reduction in their equity of 10 times, reduce their equity, to 10% of their original equity. And what did they get in exchange for that? Nothing. They're not going to get paid because there's nobody to buy their equity. We're not going to buy it, and the management team typically doesn't have the money to buy it. So basically what happened is they had to give it back. Why? Or they had to give it to the management team. And why are they going to do that? I mean, why would they ever do that? Because they're receiving nothing, they're giving up and getting nothing in return. So what they're going to get in return is the company's not going to die, because when they're sitting in the messy cap table holding 20% of the equity and no new investor ever wants to come in, then the company's going to die. So the way we usually end up negotiating this is, do you want to stay with 20%? Would you like to keep 20% of zero, or do you want to have 2% of 100 million? So 20% of zero or 2% of 100 million? 2% of 100 million is still 2 million. So so basically you want $2 million when the company succeeds, or you want zero because this company's going to fail. Now, that's not just a negotiating tactic, that's the reality. And this is often persuasive for shareholders who are serious about the future of the company. But I can tell you that's never a pleasant conversation, or never easy or pleasant negotiation to have. And it becomes even worse because oftentimes those shareholders are people that the management team had a good relationship with before this. So guaranteed, the relationship is going to suffer when we try to do this cleaning. Now, and that's the best case. The best case is we go through this painful process to renegotiate, and management team has to go back on verbal agreements that they made mistakenly, or maybe even has to reverse real agreements that were made through renegotiation. So that's the best case. Worst case is if some or all of the shareholders that are messing up the cap table don't want to do this, the new investor may come in, but they come in a new company. What does that mean? The company sets up a new company. The management team transfers, any assets of value from the old company, new company. The new company shareholding is the management team plus the new investor, and any old shareholders are left in the old company, which now has no value. So that's called the hardball way to do this, or scorched earth method. And obviously that's going to leave a very bad feeling with the shareholders who were on the short end of that stick, but that is typically the last chance that the company has to not die. So if shareholders won't prioritize the company, then management and new investors are left with few good options. So this is why it's much better not to have this situation than to clean it up later. So summarizing, avoid at all costs debt equity, dumb money investor, excessive dilution. There's no such thing as a part-time founder. Make sure that all founders have vesting from day one, which means that inactive founders give up all or part of most of their equity if they leave before vesting is finished. Never take money from anybody, no matter what your relationship with that person is, on undocumented or poorly documented terms. Don't agree to any off-market terms in any round of funding, no matter what the relationship is between you and the investor. And if you're not sure what constitutes reasonable terms, get advice from someone who really understands venture capital investment terms. Another big problem that I see in the Thai market, a lot of qualified Thai lawyers who understand even traditional investment may not have experience with venture capital deals. So you can get your lawyer friend who's even done other business deals, but isn't familiar with venture capital funding, and you might not get the right information from them. So make sure that whoever you're consulting about the reasonableness of your investment terms is familiar with venture capital investment terms. And make sure that, definitely try to make sure that founders plus ESOP are minimum 80% of the company before you get to your first VC funding round. In some cases, maybe could go as low as 70%, but target 80% and try to get to your first venture capital funding round with as much equity as possible, still held by the founding management team and ESOP plus any real financial investor. Like, for example, I mentioned the angel investor who came in, $50,000, which is 1.5 million Thai baht for 4.7%. Okay, so I have some questions in my Q&A box. So I'm going to answer the questions in the Q&A box now, but also happy to take more questions. Okay, I'll look first at there were a couple questions in the chat, so let me answer the chat questions first. The first question, and then I'll go to questions in the Q&A box. So the first question in the chat box was, if a team member gives shares to CEO for bigger share for main guy to hold, and they do agreement to give it back when company grow, is that okay? So okay, let's say that if I would generalize this question to say, if management team has arrangements with third parties around their shares, then that's generally okay, but this is also something that's going to need to be disclosed in the investment documents, because in the investment agreement and or shareholder agreement, there's going to be what's called a representation and warranty, where the major shareholders, including especially management team, is going to have to say that there are no liens and no options relating to their shareholding. So this any sort of any sort of contract between an existing shareholder and a third party around the shares is going to have to be disclosed. So if that arrangement results in the key management team member having less than the motivational share of the equity, this is going to be a problem. Now, the one thing I advise there, okay, so sometimes these problems are in family businesses, where let's say the CEO needs to take care of their family through this business, but they also need to, meaning that it's a family business that's becoming a startup, and then the CEO has to have also the majority share, super majority share, but this leaves other important family members out of the mix. Then I always advise, if you have an understanding, let's say CEO has understanding with their family members that they're going to share the proceeds from any sort of liquidation of their shares, but there's no contract, then that's perfectly legitimate. What management team does with their money after they get it from selling the shares, they can give it to anybody they want or share with anybody they want. So I think that's probably the best solution in that case. Okay. So yeah, then in the chat box, we see mostly answers to the questions, so that's good. Somebody asked about the what was the correct discount, so I think I talked about that. Okay, good. So let's go to the let's go to the questions in the question and answer box. So first question is, I have a clean cap table, like you mentioned, 89% owned by CEO, 10% by two angels, 1% owned by crowdfunding, and plan to keep 10% for staff and team. We have a holding company with 3 subsidiaries in different countries. We sold 70% to a large fintech company and kept 30% for holding company. Does it look okay? The new investor will be a very good partner for a business model. Oh, definitely never do this. Do not do this. If this is not already done, don't do it, because you should never sell 70% of your company to any single investor. no point to keep 30% of a company that you sold 70% of. I always argue you should never sell more than, you never sell anywhere between 49 and 100% of your company. You only sell a minority stake in your company or 100% of your company. Don't sell 70% to anybody. When you sell 70%, this means you're selling at a discount because you're never going to be able to sell the other 30%. As soon as someone owns 70% of your company, they already have control, and there's no incentive for them ever to buy the remaining 70%, remaining 30%. By the same token, a third-party investor they don't need to buy your 30% to get control. So all they have to do is buy 70% from the 70% owner to get control. So you will be left out of all future transactions. You can be left out of all future transactions. So definitely don't sell 70%. Sell, you should never sell 49% either. Like typically what you want to do is you want to sell less than 30% or 100% to a single investor. Now, over time, you're going to sell, you could sell 70% to multiple investors, but don't do that in a single transaction ever. Now, one exception, when your company is purchased in a M&A, it's possible that the deal may be structured in such a way that, for example, management gets 70% or even less upfront and then gets another 30% earned out over time, maybe 2 or 3 years. This is not unusual, and that type of deal you could do. Now, there you have to make sure that you have assurances in the contract that you're going to get paid the remainder, and I would also make sure that you're comfortable that in the worst case where you never get the remaining 30%, you still feel happy with that deal. So I would always discount any money that you don't get paid up front down to zero and make sure that you still want to do the deal in that case. Okay, next question was, what does Series Seed mean? Series Seed in the cap table meant that was the seed round. When venture capital investors do investments, or when startups raise money from VCs, each time they raise money, it will be defined as a funding round. So the first VC round is usually called the seed round. Second round is called Series A. Third round is called Series B, etc. So Series Seed just means it was the first funding round for the company. Next question. If we need to engage part-time founders at the beginning to get the MVP launched, what would be the max for them on the cap table to make it reasonable? I wouldn't give any equity to any part-time founders. So part-time founders can qualify for equity when they join full-time. That's it. So I would say no, like part-time founders should not have any equity, and they shouldn't be even vesting equity. Now, they can get their equity, they can begin their equity vesting when they join full-time. I know it's tempting to compensate part-time founders with equity, but I would definitely still not do that. I would say if somebody wants to be part-time, then I would try to pay them only in cash. If they are, if they're planning to join the company, then you can have an agreement with them that says, it specifies how much equity they will get when they join full-time. So let's say the founder is part-time at the beginning. They have no equity, but they do have an agreement with you that when they join full-time, they will get this much equity. And how much equity each founder should get should be determined by all of the founders jointly agreeing on how much equity each founder should have based on what each founder has already contributed to the company, but more importantly, what each founder will contribute to the company in the future. And then it also should be, the CEO should have more equity than other founders, and you definitely shouldn't just divide the equity, divide 100 by number of founders to figure out how much equity each founder should get. Whenever we see that, we immediately recognize that there was very little thought that went into this equity division. Okay, what a question. What about excessive dilution? What does it mean? Does it mean just too low or too high valuation? So excessive dilution means that founders and basically founders have too little equity. Now, it doesn't mean the same thing as too low valuation, but too low valuation leads to excessive dilution, because too low valuation means that the incoming investor got too much equity for the amount of investment, and that too much equity prior to venture capital investment will almost always have come from the founders, which means that the founders were diluted by too much. Now, just to remind, the too high valuation doesn't lead directly to excessive dilution, but in my example, it would lead to excessive dilution in the future, because the too high valuation in one round leads to a down round, meaning a future funding round with a much lower valuation that will create excessive dilution in the future. Yeah. So the next question: wouldn't setting up a new company in order to clean up the cap table cause problem for founders? Mean in the sense that wouldn't old shareholders sue them or something? So definitely, this is a scorched earth solution. Meaning, we call this like nuclear option. This is the nuclear option, meaning just going to blow everything up and get out of the old shareholding structure and into a new one. Now, can the old shareholders sue the founding team? So anybody can sue anybody for anything, anytime. Will they win the lawsuit? This depends. Did they have a shareholding agreement? If they had a shareholders agreement that prohibited the founding shareholders from setting up a new company or setting up a competitive company, then they're going to sue, and maybe probably they might have a good chance to win. If they didn't have a contract like that or an agreement like that, it's as far as I know, it's not a violation of Thai law for founders to do that. Now, I could be wrong. In other countries, it's definitely not. So if it's not illegal to do it, and if there was no contract between the parties that said that the founders couldn't do it, then the lawsuit is, if the existing shareholders do sue, then they're very likely to fail. It's also often the case that this company, the new company, might be set up in a different country. So, for example, the founders might set up a Singapore company instead of a Thai company, and the investment may go into the Singapore company next. And now the existing shareholders have a problem of suing the founders for setting up a company in another country, which again, very likely it's not violating any laws. And even in the case where they did have a contract, it might not even be violating a contract. So yeah, but definitely it's not simple, and it's going to create hard feelings. But in most cases, it's going to be hard for the old shareholders to sue and win. Okay. The next question: would you recommend to form the company as C Corp versus LLC in the early stage startup before creating cap table? So in Thailand, I think, not sure that we have C Corp and LLC. Usually we recommend always setting up as a limited company. In Singapore, we set up private limited company. In Thailand, we usually set up as a limited company. Definitely you want to set up as in whatever jurisdiction you're setting up, you want to set up as a limited liability corporation. But before creating cap table, you're going to need to create the cap table at the time that you set up the company, because in the vast majority of cases, when you set up the company, you have to specify who are the shareholders during the company setup process, you have to specify who are the shareholders and how much equity that they have. So I think these two should normally be done in at the same time. We figure out what is the initial cap table, and then we register the company with the initial cap table. Okay, next question. The existing company has already made profit, but in the case of set up a new company, new equity and beyond service from existing company, so how long do I have to wait until raise fund with the CVC? Or can I raise the fund immediately once completed setup of the new company? So I'm not sure I understand this question exactly, but it sounds like there's an existing company with profit, but the entrepreneur is setting up a new company and then they want to raise money from a VC. So, but again, you know, here we might have a problem if the founder now has two companies, which is existing company and new company, then it's going to be very difficult for the founder to raise money from venture capital investors because now they're running two companies. If they're running two companies, they're not full-time in the current startup because they have two companies. So the way I almost always advise to resolve this problem is, let's say you have the old company that made a profit and then you set up a new startup that you want to raise money for. Then have the new company own the old company. So the new company owns your old company and then you raise money into the new company. So the investor gets a share of both. They get a share of the startup, but because they own a share, because the startup owns the previous company, they also own the original, have a share in the original company. And this solves, to some degree, solves the problem of the divergence of interest that I talked about earlier that will almost always occur in a case where the founder is running two companies. It also, if the original company has a profit, it's going to have another positive effect of improving the valuation of the company that's being invested, because now the company that's being invested will actually have some profit attributable to it from the old company. Okay, next question, two parts. Question, oh, wait a sec. So there's a great question in my other box, in the chat box. How about Elon Musk in the case he owns many companies and raised money from any investor? And actually, I've got this question in the market before many times. And I always, okay, I'm going to answer like this. If everybody doesn't know, so Elon Musk is the CEO of Tesla. He's also the CEO of SpaceX, and both of these companies have raised, you know, hundreds of millions or dollars or more. And he was one of the founders of PayPal. So he's a super successful entrepreneur. And definitely, if you're Elon Musk, you can do that. So if Elon Musk wants investment from me, I'm not going to be nervous that he's running two companies. But if you're not Elon Musk, you can't do that. You know, let me put it this way. And actually Jack Dorsey also. So Jack Dorsey was a founder of Twitter and a founder of Square, two companies. So if you are an entrepreneur who has already created, you know, two multi-billion-dollar companies that have exited in, you know, NASDAQ IPOs and are some of the most successful startups in history, then definitely you can raise money from investors while running two companies. But if you're especially like a first-time entrepreneur, or, you know, you're an entrepreneur who does not have successful exits yet, you're not going to be able to get investment from VCs while you're running more than one company. So, oh, okay. Okay, so definitely, if Elon Musk is listening, I'm definitely happy to invest in any of his companies, even if he's running 3 or 4 companies at the same time. But, you know, of course, the serious answer there is, if you're already, you know, super successful entrepreneur, having made billions of dollars for investors, then there's a different set of requirements than most of the entrepreneurs that we meet in the Thai startup market. Where it's their first startup or maybe second startup, they don't have any successful exits yet, and therefore they need to be, you know, more cautious about what they're doing with their time. Okay, so there's a question, and back to my Q&A box. Is the venture builder a kind of corporate-owned startup? A startup could buy big corporate itself. And thus, so in short, is it nearly impossible for these venture builders to raise VC fund? So venture builder, there are not all VCs have the same concern about venture builders. So some VCs might be willing to invest in startups coming out of venture builders. And also I have seen recently, in the last few years, I've seen some venture builders that take very realistic stakes. So we'll see venture builders with 5% or 10% of startups and having provided real money, real cash at market rates or close to market rates, and therefore not getting themselves into the same box as the venture builders that took 30, 40% of the startups or even majority stakes of startups. So I would say not necessarily impossible for venture-built startups to raise money from VCs. The venture builder itself usually won't raise money from VC because the venture builder is not a startup, but they're more like a incubator, accelerator / VC. So next question in my Q&A box. What is the average valuation for a startup in a seed round in Southeast Asia region or Thailand specifically? And what is a popular method of calculating the valuation early stage? So we're going to have a future, we're going to have another class just on valuation. So I don't want to, it's very difficult to answer this topic, give this topic the attention it deserves in a Q&A session. So I would highly recommend, if you're interested in valuation, to join one of our upcoming sessions where we'll talk more about valuation. But I would say, to answer the first part of the question, average valuation for a seed round startup in Southeast Asia, including Thailand, is somewhere between 1 and 3 million USD, assuming that the startup has either pre-revenue or very little revenue. If the startup has more, so 1 to 3 million USD is like 30 to 90 million, Thai baht. So I think if the startup has real revenue, the number can be higher, but it shouldn't go much less than that. Oh, so there was another question in my chat box. If a company in the first stage is growing and needs more cash to inject, angel push percent to high 10 to 20%, but if no money, the company might go. What should they do? And what percent of shares should startup give to investor at each stage? So I would say the startup should expect to give between 10 and 30% equity in every funding round, with an average of around 15 to 20%. So I think if the company needs a second round of funding before, let's say they need a second round of VC funding, a second round of angel funding before they get to their VC funding round, and they want to get that funding from angel investor, and it says, the question says, if the angel pushes to high 10%, I don't think angel investors are issue in the cap table if they're investing at reasonable valuation. So if the angel has somewhere, 10%, but they have put in the money at reasonable valuations, I don't think that's going to be a problem for the startup. If the angel is pushing 20% before the VC round, I think there's going to be a problem. It's going to cause a problem for the next round investor. Now, how it might solve this problem is maybe that angel, instead of putting in the next round in the form of additional equity, maybe they come in on a convertible note. So the angel puts their second round in on a convertible note with a reasonable 10 to 20% discount in the next round. And in that case, they might wind up in the next round with a higher share. But when they come into the round, at least that money is in the form of a convertible note. Okay, another question, refer to above mentioned. Existing company already had the traction and profit, but the new company has just launched to the market, which transferred the existing key customers from the existing company, new company with a beyond service and new branding. So again, I would, in this case, I would combine the two companies rather than transfer from one company to another, because assuming that the founder is still running both of those companies, that's going to definitely create a problem in the VC round. Okay. then the next question, if we give equity to some management team, later on they want to quit, what should we do in the contract or agreement to protect that equity? So this is a great question. I mentioned several times, but I didn't explain about equity vesting. So typically when a founder, every founder in the company should have an equity vesting agreement that usually is structured something like this. The founders will earn their equity over 4 years. They will receive 25% of their equity after year 1, and then 25% every year after that. So once the founder has worked in the company for 4 years, they'll have 100% of their equity stake. If they leave within the first year, they're going to have nothing. If they leave after 1 year, they'll have 25%, et cetera, et cetera. Okay, and I'm getting the red flag. I'm getting my own red flag on having to finish with one last question, which is so difficult because I have four remaining questions. So not sure like which one to answer, but I'll say I'll answer the question second from last. So what about equity crowdfunding versus angel and VC? So equity crowdfunding, it's a interesting relatively new category of investment. Equity crowdfunding, it's not really an investor like VC or angel. Equity crowdfunding is a distribution mechanism for investment. So equity crowdfunding means that a crowdfunding site combines investments from investors to put into the company. So far, equity crowdfunding sites have had some limited success in startups, and I think the main difference between equity crowdfunding and angel and VC is that equity crowdfunding sites cannot be smart money investors by definition. They're sourcing money from the crowd, and therefore they're not going to be able to provide support for the startup beyond the investment, where good angel investors and VC investors are going to provide a lot of support for startups after investment. So I think the second problem with equity crowdfunding, typically startups don't go to equity crowdfunding because startups know that they won't receive the support from equity crowdfunding that they're going to get from good angels and VCs. And therefore, the startups that go to equity crowdfunding are not the best. The best startups get money from angel and VC, which means that equity crowdfunding investors typically are given a choice only of startups that were not able to raise money from angel or VC, which there's usually a reason for. So yeah, so I think there's still some promise in equity crowdfunding. Let's see how it develops. But for now, I think angel and VC is still the gold standard for startup funding. Okay, so sorry, don't have time to answer the remaining questions, but I'm really happy that we had too many questions to answer because I thank everybody for their active listening and their great questions in both the Q&A and chat box. If you are interested, if I didn't get a chance to answer your question, or if you have any other questions you'd like to ask, please feel free to reach out and send me email or message me on social media, and I'm happy to answer your questions after our talk today. We also have 3 more, I think, sessions scheduled in this program. So hope to see you at our upcoming sessions, and I hope we have as many great questions in those sessions as we had today. So one last point that I would like to make, when I talk about the different types of investors and different types of debt equity and cap table problems, I think it's also really important to note that a lot of times these cap table problems, they're not the result of anybody trying to do anything wrong or anything bad. They're the result of honest, differences of opinion in, how much equity people should get for doing different things, or maybe, different views about that, which are equally valid. So we shouldn't, think that, oh, because somebody had too much equity or too little equity, it means that anybody necessarily did anything, that they weren't supposed to do. So let's not make any value judgments about that. And when I talk about fixing it, again, this is not implying that anybody did anything wrong or anything they shouldn't have done. But for me, I always think about not like this is good or bad. I think about how will this affect the next round funding? So for me, it's like the reason I want to fix the cap table today is because we're going to be in the same boat with the startup in the next round. And I want to make sure that we all get the best deal in the next round. It's everything about that and nothing about what happened in the past.
Okay, all right. ขอบคุณมากๆเลยนะคะ Thank you so much, Douglas. And I think I'm pretty sure the audience have enjoyed the discussion today with lots of questions and meaningful questions. เอาละค่ะสำหรับช่วงสุดท้ายนี้นะคะแนนขออนุญาตทุกท่านอย่าเพิ่งปิดเว็บไปไหนอย่าเพิ่งหนีแนนไปไหนนะคะขออนุญาตรบกวนทุกท่านช่วยส่งกรอกแบบสอบถามค่ะและนะคะส่วนหนึ่งของโครงการ Rapid Response and Recovery Program โครงการ Support Entrepreneur Support ของ Expara นะคะเรากำลังจะจัด Fundraising Consultation นะคะทุกท่านที่ร่วมกันตอบแบบสอบถามเข้ามาแนนจะขออนุญาตส่งรายละเอียดการลงทะเบียนนะคะที่ท่านสามารถเข้ารับสิทธิ์รับ one-on-one session กับทางคุณดักลาสเพื่อปรึกษาคำถามต่างๆที่ท่านอาจจะสงสัยไม่ว่าจะเกี่ยวกับเรื่อง cap table หรือเรื่องของ business structure นะคะสำหรับในวันนี้ค่ะขออนุญาตนะคะฝากทุกท่านค่ะช่วยกรุณานะคะส่งตอบแบบสอบถามให้แนนให้ฟีดแบ็กกันมานะคะแล้วก็เราจะรีบจัดส่งทั้ง key takeaway นะคะสรุปคำถามต่างๆที่ทางคุณดักลาสอาจจะยังไม่ได้ตอบในวันนี้รวมถึงนะคะรายละเอียดในการลงทะเบียนเข้ารับ one on one consultation กับคุณดักลาสเรามี limited hours นะคะจัดไว้แค่10ชั่วโมงวันที่14 15 16ธันวาคมนี้ค่ะเอาละค่ะในช่วงท้ายนี้นะคะแนนก็ไม่ขอรบกวนเวลาทุกท่านนะคะสุดท้ายนี้นะคะถ้าเกิดสมมุติว่าวันนี้มีเหตุผิดพลาดมีขัดข้องตรงไหนนะคะแนนและทีมงานก็ต้องขออภัยไว้ณที่นี้ด้วยและกิจกรรมของเรานะคะก็จะจัดขึ้นอย่างต่อเนื่องค่ะในเดือนมกราคมกุมภาพันธ์แล้วก็มีนาคมและเมษายนในปีหน้านะคะเราก็จะมีหัวข้อเด็ดๆนะคะจากคุณดักลาสที่จะมาเจาะลึกปัญหาสารพัดสารเพนะคะในเรื่องของการระดมทุนในสตาร์ทอัพระยะเริ่มต้นกันค่ะเอาละค่ะ Douglas I'm done with the requesting the audience to give us the feedback as well as the information about the fundraising consultation if you have any particular last comment please feel free to do so
Okay, thanks so much, Nan, and I just want to thank again our partners in this program, which are SET, Stock Exchange of Thailand, YBI, Youth Business International, and all of our fellow panelists who joined today, and all of our attendees who asked really great questions. So, this is I'm very passionate about this topic and happy to have a chance to share it with the audience of people who are, able to listen and ask such good questions. So hopefully we'll see many more clean, or let's say cleaner cap tables in the future. And then we'll have startups succeed or fail based on how they do in the market rather than any type of impediments that they introduced through fundraising before they really understood how to create a clean cap table. So if we have some cleaner cap tables in the future, then our time today will have been well worth it. So thank you. This evening will have been well worth it. So thank you very much, everyone.
โอเคค่ะ alright สำหรับช่วงสุดท้ายนี้นะคะก็ต้องขอบพระคุณทุกท่านอีกครั้งค่ะสำหรับวันนี้นะคะในนามของทีมผู้จัดงานนะคะก็ต้องขอบพระคุณทุกท่านอีกครั้งนะคะและถ้ามีคำถามสงสัยอะไรอย่างไรนะคะทางทีมงานนะคะจะส่งรายละเอียดไปให้สำหรับทุกท่านที่กรุณาร่วมแบบตอบแบบสอบถามค่ะเอาละค่ะสำหรับวันนี้นะคะแนนก็ต้องขอลาทุกท่านไปก่อนนะคะสวัสดีค่ะOkay, Douglas, it's time to say goodbye to the audience. I'm going to turn off the webinar soon.
Okay, good night. Goodbye, everybody. Good night. Enjoy the rest of your week and look forward to seeing you in one of our future events.
โอเคค่ะขอบพระคุณนะคะสวัสดีค่ะ